News out of China that a proper balance will need to be struck between tight and loose monetary policy has not been friendly to investors, with stocks weighed down as a result of the less accommodative tone. But the reality is that this is exactly the type of sentiment one should expect from central bankers a decade after the implementation of an unprecedented dose of artificial policy accommodation designed to bolster investor appetite. The balance of downside risk to the global economy is no longer tilting so clearly in the direction of demanding accommodation, with plenty of financial stability risk emerging if things remain as one-sided as they have been. We believe this inevitability of less accommodative, less friendly central bank and government policy will be felt more acutely in 2019 and will result in the onset of an overdue period of sustained correction in the global equity market as investors liquidate long exposure and seek out a healthier, more balanced strategy of portfolio diversification. One of those variables that has yet to manifest that could push things more aggressively in this direction will be the onset of inflation, with central bankers forced into a position of needing to be thinking about higher interest rates to offset this very real risk. And on this very topic of inflation, we are seeing a bit of a demonstration of this fact with the price of oil shooting up after the Washington Post reported that the U.S. won't renew waivers that allow some countries, including China, India, Japan, South Korea, Italy, Greece, Turkey, and Taiwan, to buy Iranian oil without facing U.S. sanctions after they expire on May 2nd. Moving on, the UK House of Commons will return from Easter recess later this week, and a big part of the narrative will be about the fate of Theresa May and increasing pressure for her to resign by the end of June. But overall, the pound has held up well since the no-deal, disorderly Brexit risk came off the table, and overall, FX markets remain confined to a super low volatility environment with little movement seen in 2019 and markets confined to consolidation after a big run in the US dollar's favor. Super low volatility warns of a pickup in volatility, and consider we've already seen a big dollar move, and considering that global equity market could be getting closer to capitulation, we wonder if the anticipated surge in volatility will coincide with a major trend reversal, not only in stocks but in the FX market, with the dollar at risk for a big move the other way to the downside. As a reminder, trading conditions are thinner this week on account of the holiday conditions. That's all for now.